Leo Melamed, Chairman Emeritus of the CME Group, the Chicago Mercantile Exchange Group, world's biggest futures exchange, and is it, as we speak, advising the Chinese government on the creation of their brand spanking new futures market. Leo, Happy New Year. Bernie in Hong Kong, nice to have you on the show with us. A lot of questions abound out there as to the structure of how this futures market is going to operate. Can you give us sort of a snapshot about what the mindset is right now?
Well, it's a historic step, of course, for China. It's moving ahead with a futures market in financial instruments and starting out with stock index futures. For them, this is the most important step because they've had no way to hedge or take off some of the risk on the table when an investor goes into the stock market. It's caused that market to go a straight line up or a straight line down. Futures markets will give it liquidity and the ability to manage risk that they never could do. It really is a very constructive step for China's markets.
What is it? What is the net effect? I mean, if you had to sort of think, down the line, what is the first effect going to do? Will it ease some of the pricing pressures that have been inherent in the China markets for a long time? Will it close the valuation gap on the same name, for instance, between the Shanghai market and the corresponding stock that's traded here in Hong Kong?
Well, there will be many effects. You can't simply predict one or the other, but what it will do is liquefy the market and allow a variety of strategies to be utilized that can't be utilized today. In effect, all of the things like the narrowing of spreads between bid and offer, the ability to bring the two markets together will occur. This will all be very, very helpful. The main thing it will do is give the investor an opportunity not to simply buy a stock or sell a stock, but also to apply a future strategy to that stock. And it should prove to be very, very healthy for the stock market in China in terms of liquefying and making usable for many participants.
You want to provide hedging opportunities to those who are committed to China. For instance, the foreign institutional investors who are engaged in China, not on a day view or a week view or even a month view, but for years out and banking on the future of the country's development. But as in all cases of this nature, Leo, you're basically opening the gate and you can get speculators as well as hedgers. How do you attract hedgers without over-liquefying the speculators who could introduce a very hot element into the market?
Well, actually, it's the other way around. The hedgers desperately need speculators without whom they haven't got anybody to sell to or buy from at a time when they all go in the same direction. These markets only work as long as speculators come forward and use their own money to take some risk off the table from the hedgers. So the market only works when both communities come together. And I expect that in China that's going to happen. That community has the ability, of course, has known the ability to speculate over many, many years, but it's the hedgers that haven't had the ability to enter that same market. Here they will have an opportunity to apply their desires on a side-by-side basis. Okay. So the answer is, yes, we do need the speculators, and the hedgers will welcome them.
All in the name of price discovery. Leo Melamed, Chairman Emeritus, CME Group.